Welcome everyone to this presentation about wash trading in NFT markets. My name is Victor von Wachter from the University of Copenhagen, representing a team of 4 authors. Non-fungible tokens are a hot topic since 2021, driven by the launch of popular collections such as Bored Ape Yacht Club and coverage in popular media. On-chain market, the current dominant form of NFT trading, are growing in all relevant categories: trading volume, users, and NFT prices. This dramatic surge of trading volumes has led observers questioning the authenticity of on-chain volumes. We refer to on-chain markets when the marketplace is non-custodial and most of the execution and settlement is enforced by blockchain technology. A prime example of such a market is OpenSea and Rarible. Further, NFT market characteristics differ significantly from established fungible crypto markets. For example, the creation of an arbitrary amount of addresses is possible and cost-free. We will discuss this and more examples in a minute. We were guided by the research question how prevalent wash trading is in smart contract-based markets on Ethereum. Further, we wanted to know if an increased wash trading activity does increase prices of NFT collections. To answer the research question, we gathered the complete NFT trading data from Ethereum for 4 on-chain marketplaces. We conceptualize trading patterns as graph and apply 2 detection algorithms. Let's start with a quick definition of wash trading. Wash trading refers to the activity of repeatedly trading assets for the purpose of feeding misleading information to the market. These misleading information serve the strategic purpose of artificially inflating the trade volume of a given NFT collection, creating an impression of desirability to uninformed traders. More technically, wash trading includes one or more colluding agents conducting a set of trades without taking market risks that lead to no change of the initial position of the adversarial agents. Wash trading is a well-explored phenomenon in crypto markets for centralized exchanges and fungible tokens. However, wash trading in NFT markets differs significantly. Users typically connect to the markets through wallets. Thus, on-chain trading does not impose extensive onboarding or identity requirements. User can further create an arbitrary number of addresses for free and remain pseudonymous. These characteristics makes preventing illicit activities a challenging task. Further noticeable differences are a different fee structure, including marketplace fees, gas fees, and royalties, and the high transparency of blockchain technology. Lastly, whereas wash trading on centralized exchanges predominantly serves the purpose of signaling high volume and thus deep liquidity, we suspect that wash trading for NFTs is driven by individuals to contribute to individual gain. The core idea of the paper is to model a transaction graph for each NFT, whereas each address is represented by a node and each transaction by an edge. We processed a complete NFT trading history on Ethereum and applied 2 different detection algorithms. As we established, wash trading is a set of trades without taking market risks that lead to no change of the initial position of the colluding agents. Topologically, these are closed cycles, which can be detected by an adjusted deep first search algorithm. In the illustration on the bottom, one can see 6 examples of closed cycles. Example 1 is a self-trade, whereas an address sells the NFT to itself. Example 2 is a trade involving 2 agents trading an NFT back and forth. Due to the transparency of the blockchain, we can also distinguish a closed cycle involving a trade and a back transfer. This can be seen in example 3, where B sells the NFT to C and transfers it back. We also iterate our algorithm to detect multiple cycles in the graph, building on the time-stamped transactions. Example 6 depicts this phenomenon, where an NFT is used for repeated suspicious behavior. A second suspicious behavior we want to detect is a very rapid sequential trading path. In other words, an unusual fast change of hands of an NFT. Generally, this behavior indicates that both addresses B and C are held by the same real-world agent. We apply a conservative threshold and select the fastest 1 percentile of speed with only a minimal price deviation. This translates to a flipping of NFTs within 12 hours without a noticeable price deviation. The price deviation refers to not taking market risk, as before and afterwards the agent holds the same market risk. To apply our detection algorithms, we gathered NFT trading data for the top 50 NFT collections by trading volume from the Ethereum blockchain following the ERC 721 standard. To match the NFT sales to a marketplace, we manually collected all smart contract addresses of the, by then, 4 leading on-chain marketplaces: Foundation, OpenSea, Rarible, and SuperRare. The data gathered resulted in 1.78 million transactions among 460,000 addresses. Applying the two algorithms, we found that roughly 2.04% of the NFT transactions show suspicious behavior, the majority of which is detected by the closed cycle algorithm. This leads to an overall wash trading volume of $149.5 million or 2.17 of the overall trading volume. We also see that with 0.45%, a minority of NFTs are used for illicit behavior. This indicates that the same NFTs are used repeatedly. Furthermore, we detect close to non-one transaction wash trading. In other words, Bob trades with himself. This indicates that front-end or smart contracts prohibits successfully these kind of behavior on the marketplaces. A deep dive into all the numbers can be seen in the written proceeding. Please be also aware that the NFT market continued to expand since the submission of this work. The trading volume further grew drastically in 2022. Furthermore, with LuxRare, we saw the introduction of token incentives for NFT trading, which naturally fosters wash trading. We will quickly hit this development in the discussion. We are currently working on an updated version on the paper to incorporate any feedback and developments. Let's evaluate the algorithms with further analysis. One interesting aspect of wash trading is the execution time, the time it takes for the full trading cycle to close. The faster, the more likely it is that the agents act coordinated. On NFT markets, we can see that cyclic trades happen relatively fast. This illustration shows the execution time for a cycle on the x-axis. Please note that the execution time is locked. On the y-axis, we see the amount of transactions or the number of sales and transfers of a cycle. 48.4% of all detected cycles happen within 1 day, which is highlighted in red. Generally, 1-day cycles leave little room for interpretation. 13.4% of all detected cycles happen within 7 days, which is marked in orange. Only 1/4 of the detected cycles take longer than 30 days, which is the white area. Under US regulation, 30 days is an actively applied threshold for wash trading. Thus, everything below is deemed potentially suspicious. We also can see that the dominated form of closed cycles are simple patterns with 2 legs or 2 transactions. Thus, Alice trades to Bob and Bob trades back to Alice is the dominating form of wash trading. A second evaluation is to check the number of trades per address in relation to the number of unique trade partners. Indicating organic behavior, one would assume one unique trade partner per NFT trade, thus a one-to-one linear relationship. However, on NFT markets, there is certain control over the counterparty for each trade. A high number of trades with a low number of unique trade partners is potentially suspicious. The chart illustrated for each address the number of trades divided by the number of unique trade partners. Each dot represents one address. The size of each dot is equivalent to the detected number of suspicious trades via our two algorithms. The larger the dot, the more suspicious trades were found. One can see that in the red circled area we find addresses with a lot of flagged transactions. These addresses have conducted between 25 to 37 trades with 10 to 7 counterparties, thus roughly a 2-to-1 ratio. As we established, this does not indicate organic behavior. To sum it up, our proposed algorithm quantifies suspicious behavior on NFT markets. We aim for an algorithm which can be interpreted and evaluated with two illustrations. Applying the algorithm, we found that roughly 2.04% of the NFT transactions show suspicious behavior. This leads to an overall wash trading volume of $149.5 million or 2.17% of the overall volume. Both algorithms are presumably lower bound estimations. However, wash trading might not have been as prevalent as expected. We propose that fees are a natural counter to wash trading. On NFT markets, fees consist of platform fees for the marketplace, transaction fees such as gas, and royalty, a payment to the NFT artist. Generally, fees on NFT markets are very high. We also reconfirm that the transparency on blockchains is high. Blockchain technology allows to detect and analyze NFT transactions across multiple marketplaces, covering the full history. Often an underrated characteristic, this makes it very difficult to conduct illicit behavior unobserved. Answering our second research question, if wash trading has an impact on average prices of an NFT collection, we have to report mixed results. Increasing the average price of a collection could be a major motivation for colluding agents. We applied various linear regressions, but could not find statistical robust correlation. Thus, higher wash trading levels does neither indicate increase or decrease of the average price of a collection. This does not mean that illicit practices cannot be profitable. For example, selling overpriced NFTs in unique incidents or under a tax evasion perspective. Lastly, the NFT markets continued to expand since the submission of this work. With LuxRare, we saw the introduction of token incentives for NFT trading. Trading volume is incentivized through the platform's tokens, Lux. This led to astonishing volumes for collections without royalties. Thus, incentivizing trading behavior naturally fosters suspicious behavior. We are currently analyzing this topic for an updated version of the paper. Thank you very much for listening. We look forward to your feedback and discussion via email and LinkedIn. Enjoy a fruitful discussion in Granada.